Well, you know, we saw what those comments come from the Bank of England yesterday. What did they do, and was it overdone?
No, not really. I mean, I think it's pretty much as expected. I think another 25 billion, take it up to 200 billion, was exactly in line with what people thought was going to happen. So no real surprise.
People were looking at 50 billion, I thought.
Well, some people were, but I think the majority of people were really expecting 25. So that would have been our take on what the consensus was. Yeah.
Right, so where's the value here at the moment as the yields keep on going up?
Well, gilts have cheapened up over the last month relative to Treasury bonds and relative to bonds, relative to other global bond markets, and they're probably technically oversold in a way that the Treasury bond market and the other government bonds. So actually, gilts are looking relatively cheap relative to other markets at the moment.
So where would you be? I mean, in the long run or the short run?
We think the market is going to rally a little bit, and we think that the yield curve will also is starting to flatten out a bit. So you could probably, if you're looking on a sort of short to medium term view, there's probably more money to be made in 30-year bonds rather than, say, 5-year bonds.
Now, out of the G7 countries anyway, it does look like Britain has the worst possible anticipation of the worst inflation in the horizon. Yeah. Does that bother you?
No, because I think simultaneously it's probably got the worst outlook for economic growth as well. So
it's double trouble.
I can see that you're looking at a Japanese-style decade of lost growth. We can't really see any way that it's going to be very difficult for the UK to return to sort of trend growth of 2 or 3% that's sustainable, and it looks a lot more likely that you're going to have a very long period of time of a sub-performing economy.
All right. How do you rate what the Bank of England's been doing compared to, let's say, the Fed, also, of course, the European Central Bank?
Well, but the quantitative easing that the Bank of England has been doing is proportionally greater than what the Fed has been doing relative to the size of the British economy, likewise in Europe. And the big problem with it, this is where the big debate is, they've done all this quantitative easing, you've had a huge increase in the narrow measure of money supply, but no increase at all in the wider measures. It's not coming through to end bank lending, and I suspect, and we've sort of propounded this theory before, that if it doesn't work, I don't think you can rule out Swedish-style negative interest rates in the UK.
That's to penalise...
To try and force the banks to on-lend all this money that's been pumped into the system at one end, to try and force it to on-lend out to the other end. Because it's all right...
What you're talking about, in simple terms, is borrowing at 50 basis points and putting it back on deposit at 3% plus.
Yeah, because... the problem is that with the big companies like the Glaxos and the Vodafones, they can borrow money in the corporate bond market. It doesn't really matter to them too much whether they can borrow. But the small and medium-sized companies in the UK don't have access to the corporate bond market, so they need the banks to lend them the money. And for whatever reason, the banks aren't lending the money at the moment, and that's really the problem that is now going to, I think, shift. The focus of attention is going to shift away from the QE. They've done the big chunk of the QE. It's now going to shift on how do we get bank lending going to small and medium-sized companies.
Right, and the ECB, of course, has taken a slightly different approach, and how's that panning out?
Well, their economies are slightly different, and they've had a different approach. And so far, if you believe the numbers, the German and French economy have started to recover, where if you believe...
You don't believe the numbers is what you're suggesting?
Well... there's a history of UK GDP figures being revised up. So the numbers show the UK economy is still in recession, but an awful lot of people are expecting those numbers to be subsequently revised to show that maybe we're not in recession. But just because the economy stopped going down doesn't mean it's going to start roaring back up. All these numbers really show is that it's stopped going down.
That's the hope rather than the expectation.
Yeah, exactly.
And, but I mean, we are possibly looking at double dip?
Yes, I mean, I think a double dip or a long, protracted period of sub-trend growth is far more likely than a rip-roaring recovery.
Ian, always a pleasure, never a chore. Ian Williams there from Charteris. He runs the Charteris City Financial Strategic Gilt Fund, the best-performing fund for British government bonds since its launch in 2006.